Hi, welcome to the Market Alert for Friday the 13th. Today is a big one. Grab yourself a cup of tea. There is a huge amount to get through today, putting all the pieces of the jigsaw together from all of the videos I've done over the years to show you how this is unfolding and where we are heading. Yesterday I spoke about the market being limit down, how this was going to progress. It isn't going to be pretty. We get bounces, but then we continue lower. Black Thursday yesterday, one giant margin call. You're damn right it was. Never seen a move like it. Drags down at 10%. So let's start off with this. This is the Dow in the pre-market session. Unfortunately, it doesn't go back as far as I would hoped, but basically we just kept getting the circuit breakers on, and then the market would be quiet for 15 minutes, and then you would get these spikes to the upside as they tried to buy the futures market to bring it out of the circuit breaker and limit down situation. So what I did was record the session for you, and I'm going to fast forward through this, and this is how it kicked off at 1:30. The market just dropping 100, 200, 300 points, and then of course it just continued down. We had a bit of a bounce, and then we dropped again. So within 15 minutes we'd already dropped 100, 200, 300, 400, 500, 600, 700 points there, and then down we go, 750 points, and that's without what had happened in the background. And then the circuit breakers were on again, the circuit breakers came off, and then we had some stability in the market. I mean, this is just massive. I mean, this 5-minute bar here, again, is 100, 200, 300, 400, 500, and then 600, 700 back. We see the buying coming into the market, and then we move forward. And I'm going to fast forward because what I want to show you is the lies. So the market then traded back down and managed to grab 271 points at one time in this. It was wild. I mean, seriously wild. And then went out, came back, and this had happened. Or it was just in the throes of happening when I came back, and I thought, what is going on here? And I thought, well, it's got to be the Fed. There's no doubts about that. And I said to a friend, trader friend in Panama yesterday, wait for the stimulus today. It's the only thing that's going to help the market. So I'm just going to switch. Find what it is I'm looking for. Here we go. So where is it? Where is it? I'll have to just go through them and find them. I've got that many things open for you today. Here we go. So straight away, this comes up on Zero Hedge, and note this 4 trillion. And I thought, Jesus, that's some amount of money to pump into the markets. It's for the repo, and the repo is important because we've spoken about this since September the 11th when they started the repo program. It was only going to last for 5 days. It was only 35 billion, and now 4 trillion. 4 trillion, not QE to QE. And I thought, my God, no wonder the market moved up 1,500 points in one go. And I thought, this is strange, this is. Anyway, later on, I see a video on YouTube, and I see this headline that says 1.5 trillion repo bailout expands, not QE to QE5. And I thought, hang on a minute, what's going on here? So whether it was the Fed, Zero Hedge, or whatever, or whether it was just a press report, but this 4 trillion was the catalyst. And this, of course, sent the market. This is a bazooka move. There's no doubts about that. However, the problem is that money didn't go into the stock market. There was an announcement to say that they were going to keep the banking system liquidity up. And they've increased it from, I don't know, I think it was 75 billion to 1.5 trillion. And it's just insane. So all of a sudden, the money isn't going into the market where it's been going for the last 10 or 11 years since the 2008 crisis. And guess what? The Dow comes all the way back down and makes a new low, having lost 2,000 points from the peak. So yeah, insanity to say the least. But I found this fascinating. And I don't, like I say, I can't prove one way or the other. But 4 trillion down to 1.5 trillion. This is no good for the market. This is for the banking system. So that got me thinking about Charles Nenner. And Charles Nenner, an interview at the moment on Greg Hunter's channel. If you remember, in some of the market alerts, Charles Nenner in January of last year made the prediction that we would go down to 640 on Deutsche Bank, and if we broke it, then Deutsche Bank would go to zero. Now, it took a moment or two, but you can see the decline there from $11 all the way down to yesterday's low of, where did we close? 575. Now, Deutsche Bank is a problem. I've done videos on this years ago about its interconnectedness with other banks. And as you can see here, Deutsche Bank, this is why it's so important to watch what's going on in the banks, because Deutsche Bank is connected in some way, shape, form or another with derivatives to all of these other banks, and namely some of the UK banks, or well, not HSBC, but certainly RBS, which is just tucked away down. Whoops, there it is. You'll see RBS, Barclays Bank, and then you'll see all the other familiar ones as well: Bank of China, Wells Fargo, HSBC, Standard Chartered. And you can see all of those connections there to Deutsche Bank. And this is why we've got this. This is what this is all about. As I've said before in the market alerts as well, you can go back and check that the repo market for me was for Deutsche Bank when it first started, because of the trillions and trillions of dollars that they have in derivatives. So Charles Nenner's talking about this with Greg Hunter. He talks about it at 2038 and where it's going to go. So have a listen to this. I'm not going to play it in here because it's going to be long enough as it is. So take a look at that one. But yeah, keep this in mind. I've shown this before in a video going back 6 or 7 years ago. It's just a matter of time before it all came. Well, as I said before, they never cured the problem in the banking system. The Federal Reserve just pumped the markets, which is why we saw the drop in January 2008. December 2018, when they tried to remove the debt off the balance sheet, when the Fed tried to reduce their balance sheet, and then in the end they had to give up, and then they pumped the markets back up again. So it's been waiting to happen. I mean, it's just that the coronavirus is the catalyst, the black swan event that is going to send the market south. Yes, it's going to bounce, but new highs, I very much doubt it. If a bazooka of 1.5 trillion can't hold the market, rate cuts galore going on. Lagarde yesterday, that lovely criminal, she wouldn't cut rates because they can't cut rates because they're already negative in Europe. And she said that we'll expand QE until the end of the year. I mean, that means indefinitely. That's just a euphemism for we're not going to be able to stop, as I've said before in the market alert. And this, no doubt, will continue. As simple as that. So let's have a look at a few other things. I mean, this is the monthly chart. I mean, it comes to something when, as an intraday trader, you're looking at this far out, but you can see the 200 MA broken. We went down to 21.59 that I marked up yesterday. The daily chart, it's just fallen off a cliff. And overnight, you can see the markets are having a bit of a bounce at the moment. How long this will last, who knows? Watch the DP level, watch the 5 bar. We could soon be going south once more. Cluster of buying there on the overnight. But it seems to have run out of steam at the moment, as you can see there. Right, let's have a look at a few other things, like the implied volatility. This through the roof. I'm going to go to this chart. This is all of the data that I've had. We've seen this for the last couple of days. We've exceeded the 2008, and a lot of traders and analysts are saying this is worse than 2008. And as I've said in videos in times gone by, that 2008 was the warm-up act for what is actually coming. You can't say that you haven't been warned about this. I've been ridiculed. I've been called the prophet of doom, a conspiracy theorist, and all the rest of it. But it was never cured. as was seen by the Fed's balance sheet pumping the market up. They tried to reduce the balance sheet. They failed miserably because the stock market started to drop. It's all been smoke and mirrors. And the illusion is over. As you can see here, massive implied volatility there. Also, the bonds yields flying up. We spoke about this last week, that we had the inversion, and now we've got the rise in the bond yields, as we've seen before. Again, we've spoken about this for over a year. We've got all of the recessions, previous recessions. We have the inversion before the recession, inversion before the recession, and now we're seeing the spike in the yields there between the 3-month and the 10-year. Oh, sorry, the 2-year and 10-year, I think. I can't remember. I've done it that long. Anyway, whichever combination it is, the pattern's there to be seen. And yeah, I said June of last year, based upon the analysis that I did. Just a repeatable pattern, and that is now coming to fruition. And again, it still makes me wonder about the hysteria surrounding the coronavirus, whether this is just pure coincidence and allows them, because really, in reality, this coronavirus is a bit of a farce as far as the statistics, the flu and all the rest of it. There are many other far worse things that have happened or happen every year with flu, etc. I'm not an expert in this field, but it just doesn't make any sense. There's no rational thinking about this whatsoever, just hysteria by the mainstream media. It makes it look as if it's a combined effort to make sure that nobody gets the blame as far as the correction in the financial markets is concerned, or the, as I say, the controlled demolition would probably be more closer. So yeah, there we go. We've got some very interesting things happening. Like I say, keep an eye on Deutsche Bank. Now Charles Nenner's prediction has come to fruition. He's also talking about the Dow at 5,000. He was laughed at when he said to his clients 2 months ago, everybody out of the market. He used to work at Goldman Sachs. He's been in the industry for 35 years, and his cycles show that within the next 2 years you could quite easily see the Dow back down at 5,000. Will it be? I don't know. But one thing's for sure, the only thing that I do know is that 2008 was never a fix. It was basically just painting over the cracks of what was really underneath, and that has continued to mushroom. And the culprit and the problem, and as I keep saying and have said, that the repo market overnight explosion has been for this bank because of what you can see there. It's interesting, isn't it, when you actually look at this February 2020, how this has come down. I'm just having a look here, just see if we can have a see. Just trying to find something here. Let me just have a look. So the repo started in September. There was a rally in Deutsche Bank, and that was probably the relief rally that it was receiving overnight funding liquidity. The Fed said there were no foreign banks that were receiving the overnight liquidity. They then admitted that there was. They wouldn't release who it was. But I think looking at this chart, we can put 2 and 2 together now and see who exactly it was. After Deutsche Bank hit 647 in August of last year, the interesting thing that the repo market then kicks in liquidity, overnight liquidity from September the 11th, and then all of a sudden it changes, because I think there's something wrong with the derivatives and in the Deutsche Bank sector. Okay, that will do it for this one. It's a long one. Like I say, have a look at Charles's interview. Great interview. And yeah, let's see what happens today. As ever, thanks for watching. Remain deadly calm, amazingly cheerful, and I will see you in the next one.